Thank you for joining me for a quick look at our chart of the day. Before getting to the chart, I want to define some terms. Market breadth indicators, which can be very useful in reducing risk, measure the degree of participation in a market move. So, for example, the advanced decline line is a fairly popular breadth indicator. And what that does is every day it counts the number of stocks that go up and down. And then each day's total is added to the previous day. So in a bull market, we see the advanced decline line rising. That indicates most stocks are moving up. When that relationship reverses, we often see a reversal in the trend. Now, breadth can also be based on volume or other metrics, such as a moving average or MACD signal. In a strong trend, no matter how you measure breadth, most individual stocks should be moving in the same direction as the general averages. So that makes breadth, as you'll see, a useful indicator for risk-averse investors. Now let's look at one of the most popular breadth indicators among analysts who follow breadth. And what we do is we count the number of stocks in the S&P 500 that are above their 200-day moving average. You can do this with other indexes as well. And if you'd like to follow this indicator in real time, it is available for free on charting sites such as stockcharts.com. Now, the 200-day moving average is a long-term indicator. If a stock's above that average, it's in an uptrend. Below, it's in a downtrend. Let's say you follow this indicator and the key level is 65%. When this indicator falls below 65%, the market tends to be weak. Over the past 10 years, you would have never lost more than 14.2% if you were out of the market when this indicator fell below 65. All of the big declines come when the indicator is below 65. So this is a way to manage risk. Now, right now, it's down. It's below 65%. And that tells us that the market looks weak right now. So each signal is not going to indicate a bear market, and it can and does reverse quickly, but it's worth paying attention to. What exactly does it mean? Well, first of all, it should be watched for potential reversal. A move above 65 is going to be a clear buy signal. Until we get there, you should think about adding new money to the market very much. You should think a lot about adding new money to the market, and you should think carefully before doing so. Make sure your buys are well researched and your risk is managed. If you're an index fund investor, perhaps you should avoid adding to those investments until the indicator is bullish. Remember, the largest declines come after it's obvious we're in a bear market. You can certainly follow that approach of buying on weakness. However, you're risking very large losses. Could be better to wait for strength and buy into strength like we do with any relative strength or momentum strategy. That's all I have. Thank you for joining me.